Good evening, everyone, and welcome to WCMU TV's Ask the Specialist. My name is Mike Harder. I'll be your host tonight, and after a brief break, we'll be back with your questions. Well, the last time I looked around my office, it's tax time. So I got to figure folks are really involved with their finances. So we thought it'd be a great idea if we invited a couple professionals to come in and answer your questions about financial planning. Now, financial planning is not just taxes and investments. There's a lot of other areas that you need to be in tune with. So we've got a couple pros here. So if you have questions certainly about taxes or investing, that's great. But anything on retirement, estate, education, or insurance, we'd like to hear from you tonight. Now, we've got a number of ways you can get hold of us. We've got phone number, we're on the Facebook, and if you want to tweet us, that'd be great. So let's meet our folks for tonight. With us, returning veteran, we have Charlie Walmsley. Charlie's with Ameriprise Financial in Mount Pleasant. Welcome, Charlie.
It's a pleasure to be here. Thanks for having me.
And a new guy, Brian Weifrich. Thanks, Brian, for coming. I'm going to tell you a little bit of story about Brian here that he's given to me, but a little bit of a disclaimer here, so bear with me as we get through some compliance
legal
information. Sure. Brian's with Waddell & Reed in Mount Pleasant. Securities and investment advisory services are offered through Waddell & Reed, a broker-dealer member, FINRA and SIPC. The information presented on this show is solely for information purposes, is not to be construed as an offer to sell or solicitation of an offer to buy any financial product or service mentioned. Any opinions expressed on those of the financial advisors present is the subject to change based on the market and other conditions. Waddell & Reed does not offer tax or legal advice. Please consult a professional prior to making a financial decision. So, folks, we're going to be taking some broad brush answers to your questions. We're not going to be telling you what to buy, what to sell as far as financial products, but certainly we can get in some real detail stuff for folks. Before we get into our questions, let's talk a little about the Certified Financial Planner, the CFP designation. How do you get it? How does it differentiate you from other financial planners? Because I know that anybody could call themselves a financial planner. So what's important about the CFP? I'll throw that out to you, either one of you guys.
Well, the CFP, when I got the CFP in 1995, it was a series of educational components that there are 6 courses we have to take, and you complete the courses, and then we have to sit through a day-and-a-half exam and pass the exam. So it's education. And then we have to maintain our continuing education credits. We have to abide by the standards of the CFP board. We have to essentially act as a fiduciary for our clients. We have to hold their best interests first. And when we do financial planning, I'll let you finish.
Yeah, absolutely. One of the big things with the CFP is the ethical component, and we all like to think that everybody in the industry is ethical. The CFP designation, we've kind of taken that vow that we are going to do always what's in the best interest of the client, and part of those continuing education credits, 2 of those credits every 2 years has to be in the ethical component to make sure we're up to speed on that.
Yeah, like I said, we like to think, but there are folks out there that sometimes the client is not the #1 person in the room, and so it's very important that when folks are looking for financial planners that you make sure that trust is of the utmost, and you are the #1, the client is the #1 person in the room as far as where the advice is going.
Exactly.
So, good stuff. Okay. Financial planning in general, what are some areas where folks may be just not paying attention to? I mean, we like money, people like, investments, how am I doing? But there may be some other areas they're not looking at that could come up and crop up and take out some of that hard work in other financial areas. So
yeah, I think for me in my practice, when I am working with, say, a young married couple, the one thing that is overlooked, you'd think it'd be a very basic thing, Mike, but it's the budget. And nobody likes to live on a budget, nobody likes to follow a budget, but the financial planning process requires us to have money to set aside for saving, money set aside to make sure our insurance protections are there. But if you don't have an idea of where you're spending your money every month, all of a sudden you have more month at the end of the money, than vice versa. So I really try to hammer down to my clients, look, we need to make sure we're spending appropriately and controlling debt and making sure that we're not overspending and stretching ourselves too thin. So.
Charlie?
Absolutely. And in some other areas, the financial position is something that's very important. Like Brian mentioned, the cash flow in and out. I like to keep track of clients' net worth. It's part of it. It's related to that. Your debt and your equity. I like to keep track of that every year, and that's something most people don't know what their net worth is. Estate planning is certainly an area where a lot of people people neglect. And I have, I'll remind clients every year, have you completed your estate plan? And simple little things like just going over and making sure all your beneficiary designations are correct. And then, of course, insurance and risk. We all like to do investments, but it's important to understand what happens in case there is a disaster. Are you covered in the event your auto insurance, your homeowner's insurance, your long-term care life insurance, all those areas have to be addressed.
Right, right. I'd also like to add that I think in the area of long-term care is a big concern for clients. As we know, we have a lot of financial constraints going on and budget cuts, and so things are going to change. They're always changing as they are now, but they're going to continue to change. So folks really need to be prepared in the event that some extended nursing home care is necessary. And I think in general, retirement planning too. Folks really don't, like I said, Brian, maybe it's the kind of the ostrich in the sand. Yeah. They really don't want to know how much money they need to save to prepare for retirement. And the old pension plans that we see are coming under fire. They're difficult to support. They're becoming more like the 401k plans where it's up to the individual to save. So more onerous on the individual, and folks really, it's hard to get them to want to put a pencil to that.
And sometimes they never really looked at that Social Security statement that they get every year, or they get online now.
Sure.
They think that's going to be enough, and then they start putting a pencil to it and say, wait a minute, I'm going from a $40,000 or a $50,000 a year salary or income to all of a sudden my Social Security is $1,500 a month. Well, how's that going to work? And they're scared to look at it, or they don't want to look at it.
And we just don't know about the that particular system in the future. Right. I have some clients that just say, let's not count it. Let's just not even think about that. If I get it, great. Otherwise, not really wanting to put in the equation and be unpleasantly surprised. Right. Okay, we've got a few questions here. Let's get to them. Schwartz Creek, Michigan, 69-year-old in good health, has 2 Roth IRA conversions. Should I make my yearly conversions into new Roth IRAs or the existing one? So I guess adding on, I think. Can you add on to the conversion, or do you have to establish a new one?
No, you can add on to the conversion. You can convert into your existing Roth IRA account, depending on the custodian. But the important thing is that you need to track the year in which you make that conversion, because there's a 5-year waiting period, regardless of your age, to access that money tax-free. So if you can convert into the existing account. Okay.
I like to simplify clients' lives, and as you get older, if they're the same thing, if they're 2 Roth IRA conversions or conversion Roths, you might as well, if you can, combine them so that you're one less account to keep track of, as long as there's nothing else going on.
In contrast, if from the IRA standpoint, if you have an inherited IRA, you cannot commingle that with other IRA accounts because of the distribution rules. So, if from our callers, if you inherit an IRA, that's great. Just don't mix it with other IRAs that you have from other sources, because you'll accelerate the taxation.
Have to be separate. You got it.
Yeah. Okay. Great. Boyne City call. When is a will and a revocable trust necessary? Do you need both of them? Thoughts there?
Well,
a will and a trust.
Generally, in estate planning, those are 2 very different things. I mean, the will take care of some basic estate planning. Trust is a little bit more on the advanced side. If you have specific property or specific things that you want to go to specific people or places, will is going to be more general. There's not a cut and dry. When do you need one? When do you don't? A lot of people think that by having those things, they're going to save different levels of money in estate taxes, and sometimes that's not the case. So it's best to check with your estate planning attorney and make sure, do I really need both of these, or one or the other, and in what case do I need to switch from the basic will to a living trust or a revocable trust?
Okay.
Yeah, I go along with that. A will is a set of instructions to the probate court, and most professional estate planning attorneys will put a pour-over will in with the living trust that says anything we forgot to put in the trust, this will tells the court to put in the trust.
Right.
So if your situation warrants a living trust, then you typically have a will anyway.
You typically see it.
Yes.
You want the trust to work, but you've got to fund that trust too. If you have a revocable trust, it's great to
Absolutely.
have that paperwork there, but you actually physically got to get those assets in that trust,
Yes.
named, title change, etc. Otherwise, the trust has nothing to operate on.
Absolutely.
It kind of backfires on your
Yes,
plans.
I've seen several cases like that where people have a trust and they think they're set and there's nothing in it.
Yeah, it's empty. Okay, we got a call here from Manistee. A caller is in a group home. Do I need to file taxes? So is it your residency, or what's the factors for needing to file tax returns?
Well, I'm not a tax expert when it comes to the specific requirements. Obviously, if there's any earned income and if there's been any sources of income that there have been tax withholdings, you're going to want to file a tax return, because if you're at an age or an income level where you don't owe taxes, you'll get that money back. But I'm not sure on the specific limits of when you need
No,
to
but
and when you
it's an
don't.
income issue.
It's a dollar
It is,
amount.
definitely
It's
is,
a dollar
yeah.
amount of income. Was it 5,000 for an individual or 6,000 or?
Yeah. You with your exemption and your standard deduction, you're well into that on a single person.
Right. Yes.
But even though you may not need to file a federal return, you may want to look at that Michigan return, because our caller here was in a group home. Some assisted living homes, there's a real estate component to what they're paying, and they may get a property tax credit from
Yes.
that. So be careful there that you just don't ignore a possible refund there. Okay, 65-year-old from Traverse City. Should I start taking my money out of my 401k to put in a Roth IRA now instead of waiting later?
I think that's a very common question that I get a lot of. You've got these people with sources of taxable income, IRAs, 401ks that the caller mentioned. The question really comes, when do you want to pay tax on that? If you do the conversion or take that money out to convert or to spend, you're going to be paying tax on those dollars. So the uncertainty is you're not really sure. Maybe they can predict what their income is going to be down the road. We can't really predict what their income is, or we can't really predict what tax rates are going to be down the road. So typically the longer you have to wait, if you want some tax-free money, the Roth is a nice thing, but every case is so different when it comes to the other income that they have. Should you take it now? Should you wait? There's a lot of uncertainty in those cases.
Yeah.
Yes, and in some cases where we have say a retired couple, and their income is Social Security and their 401k or their IRA income, and if they're taking $10,000 or $12,000 a year out of that account, they're not paying any tax. They're still in a zero bracket. So in some cases, a Roth is just not warranted, because you may take tax-free dollars out of your IRA.
Okay, good. Another estate planning question here. Try to keep it in a level that we're all comfortable answering here.
Sure.
Certainly attorneys are critical in these areas, but if I have all my retirement accounts, bank accounts have beneficiaries. Home has a designation, a Lady Bird deed they're mentioning here, and they have a will. Does this avoid probate? So let's talk about beneficiary designations and how that plays into estate planning.
Well, the answer is the beneficiary designation, yes, does avoid probate. Because it's on the account. If the account says what happens to this money when you die, then there's no probate court involved, and that is sort of what we might call a poor man's estate plan, where we just have beneficiary designations. We avoid probate. What can happen, the downside of a case like that, is if you have all of your liquid assets with beneficiary designations, say to your children, you die, all that money gets paid out to your children. There's no money left in your estate. There's no money left for a trustee or an executor to say who's going to pay your final expenses, who's going to pay for the real estate costs while your house is being sold. So then your children have to agree to who's going to write these checks that go back into the estate. So it is important to have a trust or some kind of a receptacle for money after you die, so that your final expenses can be paid.
Plus the fact if it's a beneficiary and you're asking them to put money back into the kitty per se, then that may accelerate their taking money out of the retirement account to begin with, pay taxes on that, and then put the money in.
And
So
it
that
can
could,
cause disagreements among your heirs.
oh,
That's, you know.
disagreements happen when in families. Okay.
I've seen some of the best closely knit families when money starts coming involved. It's amazing how that might change things.
Right.
So.
You guys, any experiences with reverse mortgages? Got a call here about reverse mortgages. Basically, are they a good idea?
Yeah, I don't have a lot of experience with them. Our firm doesn't deal with them. I know a little bit enough to be dangerous about them, but it really comes down to an income issue and what other assets are there.
So
to
what
pull
what
from,
is the
so.
what is, I guess, the appeal of a reverse mortgage? What are they trying to do there? What are they saying?
A reverse mortgage is a loan on your residence that you don't pay off until you sell the house. So you die or sell the house, then the loan has to be paid off.
Okay.
They're not. It's appropriate for a person who has a lot of real estate and they don't have any income, and maybe they don't have heirs they care about. You know, I have seen a case. I had a case where I had a person with no heirs and a lot of real estate and a high income need, and in this case a reverse mortgage, I had her look up a reverse mortgage, and in that case, in rare cases, but what you're doing is you're using up the equity in your house, and they're fairly expensive. There are initial costs because there's there are some federal agencies that charge a 2% charge right up front for the oversight and the regulation, and then typically there'll be an upfront fee. You may pay up to 2 or 3%, I think, up front for your account.
But if somebody had a sizable home in value, but just in other liquid assets, and they're sitting here and they've got this value, that is one way, I guess,
it's one way
of getting some money out.
So they can have some income.
Sure. Yeah. Okay. All right. Call from Mount Pleasant. I have several IRAs and retirement accounts and mutual funds in several locations. Brian talked about this. I'd like to combine them all under one roof. Are the companies required to consolidate accounts? So
Companies are really never required. I get this question. Sometimes you'll have a client that comes in with a statement that says, I've got 3 or 4 different IRAs held at a local bank. And it just was a very simple case of, they would buy a CD IRA or something that, every time they went to do their contribution, they would get a new account in a new IRA. The companies are never required to consolidate those. I always think it's, if the mechanism is available to do that, it just simplifies your life. But the companies are usually never required. Some cases it might be you've got an IRA that you've got a certain beneficiary that you want it to go to the kids, and then you have another IRA that you've got that designated for your church or your local charity that you want to give to. So there are some advantages to having separate IRAs, but in some cases it's just as easy to combine them or consolidate.
Charlie, why don't you speak a little bit about the different kinds of securities? I mean, you've got XYZ mutual fund here and ABC mutual fund over here. Can you pull those together in most cases? I mean, in the combining, or do you have to liquidate one to get the money over?
If you're
how portable are our investments?
Most
nowadays?
investments are pretty portable. I mean, if you have mutual funds, if you have stocks, if you have a CD at the bank, it's going to have a maturity date. So you may have a penalty until that maturity date. If you have an annuity account, most annuities have surrender charge periods, and you want to be careful about closing out an annuity before the surrender charge, which is typically 7 to 10 years. I've seen them longer than that.
Yep.
But typically you can combine those accounts in quite often. If you're using a brokerage account, you have mutual fund stocks, you can do an in-kind transfer, they call, where you have the, like you said, Mike, the XYZ mutual fund over here and the ABC mutual fund over here. You can do an in-kind transfer and just bring those actual assets into an account. You can do that.
So yeah, it gives a little bit of comfort that you don't have to sell stuff you like, unless it's probably a real proprietary type of an investment,
Yes.
and then you will. But most stuff moves pretty smoothly, and so consolidation is at hand. It's available.
Sure.
All right, great. I got a call here from St. Ignace. After inheriting money, I invested into a Roth IRA. I was told that I can only take the money out at 65 and a half. What kind of charges occur if I take the money out early?
Well, 65 and a half is a new age limit to me. That one usually
That's
it's
one of my students.
Yeah, that's one of your students. That's one of your students. Usually the Roth IRA limit is age 59 and a half.
Okay.
There is the 5-year rule that Charlie talked about with the money needing to be there. But there could be a situation, maybe the IRA is in some kind of an annuity where there's not a surrender, there's a surrender period of, maybe the surrender period is up at the age that this individual happens to be 65 and a half. But that number's new to me. I'm not sure.
right.
And if it's if you inherit a Roth IRA, distributions from a Roth IRA to a named beneficiary are not taxable.
Yeah.
So there's no, not
Yeah,
even
I don't know if that was already in a Roth
sounds like she
form
might have-
or
she might
just
have
put money
invested,
into
yeah.
it in the Roth here.
Oh, if
But-
you inherited money and put it in a Roth.
Yeah,
that's-
but most Roth accounts, if you put money into a Roth, you can always get your contributions out.
Yes, that's correct.
Without taxes or penalties. So
Yes.
that part's pretty clear. So it's accessible and to that extent.
Yes.
Okay. Call here from Alma. I've heard a lot of pros and cons about variable rate mortgages. What are some of the pros nowadays?
Well, again,
Variable.
we don't deal with mortgages.
Sure,
or not
but
mortgages,
just financial planning,
Just
just-
in
yeah.
general,
Yeah.
some of the advantages would be in a low interest rate environment that we've seen lately. Some of those adjustable rate mortgages are a little lower initially.
So like they're negative?
Well,
How low
well,
can they be?
that
Yeah.
to me is why
Yeah.
when you look at, as you're doing long-term planning, they're fewer and far between now because
Right.
the fixed rate loans are so low that so some of those advantages, if cash flow is an issue, back in the day when interest rates were higher,
Well, yeah.
that would be the big benefit, is to take advantage of some lower rates when it's easier to make those payments early on.
You would
Yes,
just
and
think
it-
that, where's the trend going here, Charlie?
In this environment right now, I can't imagine that anyone even proposes a variable
Yeah.
rate mortgage, because when you can lock in 30-year money for less than 4% or 3.5%,
Yeah.
I don't know, a variable rate mortgage is advantageous, like Brian said, in high interest rate environment where you can hope interest rates go down. But
I can think of more cons and more
Yeah.
negative
At this-
effects in this current environment.
I would have to agree with you there. Another caller from Mount Pleasant. I'm getting married and think we should have a joint banking account. Is that smart, or should we keep separate accounts? Any probably what's the pros and cons? I guess maybe single ownership versus joint.
well, joint ownership, you both have rights to the account. You can both write checks. You can both put money in, take money out. If, heaven forbid, something happens to one partner, then there's no probate to settle out the account.
Yeah, I'm right there with them. I mean, I think
Yeah.
registering it as a joint account makes the most sense, because then you're making sure that the remaining spouse would get that money. Easier to do a budget together if you
Sure.
kind of know where the money is at.
Right. I guess the only thing I might add is if just as long as the right hand and the left hand know what's going on
Right.
in the account. If
Exactly.
you're not, somebody's making a debit withdrawal and doing these things, and all of a sudden the account's
Yeah.
not the balance you thought it
In
was.
in these days of a cashless society, is how people think. If you each have a debit card, or you
Yeah.
got to make sure you know.
gotta reconcile that thing once in a while, right?
Absolutely,
Yes.
absolutely. Yeah.
Okay. Should I balance my Roth and traditional IRAs for tax purpose? So what's the funding? What do you guys, when do you recommend somebody do the traditional versus the Roth?
Well, first and foremost, you can do both. I mean, some people, you can make a contribution to both in the same year. I mean, some people think, well, you can only do one or the other. So you can certainly do both, provided that your income was where it needs to be. It really comes down to your retirement assets and your sources of income during retirement. Are they a taxable source of income, such as a pension, or are they a non-taxable source, such as are you going to live off Roths and things like that? So I think a good combination always is it's to diversify from a tax standpoint, but you can do both if it makes sense.
We're getting down to the last few minutes. We'll try to maybe rapid fire through as many of these as we can here. Do they offer classes on financial planning? Are they free? How do you sign up? So where would you recommend if somebody wants to kind of get brought up to speed a little bit on some financial planning? Any easy or quick? Not quick, but what do you?
Yeah, I don't know if a
Reading
lot of
classes online, what do you-
some local organizations will offer different financial planning through the church or through a service organization. You can always take a class at a local university or local community college. There's a lot of basic financial planning courses through Central Michigan, for example. They've got some basic courses. So.
And certainly reading goes a long way.
Oh,
too.
absolutely. There's
You got
lots
some
of-
good
lots of
magazines,
material,
some
yeah.
materials. Okay.
Sure.
Okay. Advantages. Again, Mount Pleasant advantage to a fee-only planner versus a commission-based planner. Any advantages, disadvantages?
A fee-only planner is one who charges a fee, maybe a fee under assets under management, or a nominal fee for financial planning, and you pay for services and you pay for advice. A commission-based planner is paid from the products that are bought and sold. You know, I do mostly fee-based type planning, and so I'm kind of oriented in that way, but I know people have both types do very good job, and there are very good people in both categories, and I've seen people investors be very successful with both
I think in
means.
personal preference, it can come down to both. Like
Yeah,
Charlie said,
yeah.
we have at our firm we have clients that do both. It just
Right.
whatever they're comfortable with. If you trust your advisor, commission-based gets a bad rap sometimes because of that word commission. But
Right.
if you trust your advisor and you're happy with that
Yeah,
advice,
I think you nailed it there, Brian. It's really a matter of trust.
Absolutely.
Yes.
Everybody's going to get paid. There's no freebies. I mean, I think that's really one thing in this industry that, well, they don't charge me. Well, there's
Somebody's-
charges going on here, okay, folks?
Yes.
Nothing's for free.
Right.
So there are charges, and people do it a different way. I think what's important is that it's very transparent. You know exactly, because I've had some clients come into my office, and I ask them, well, do you know how much you were paying for this? And they really don't know.
Right.
And if they don't know, I think kind of shame on you where they came from, that you weren't really open to them to tell me exactly what they're paying for the service.
Yep.
Okay? All right, one last quickie here, and then we'll wrap up. But can you deduct mortgage interest on your taxes if you don't itemize?
No.
No. Right, you got the standard
Easy.
deduction. All right, well, that's going to wrap it up, folks. Thank you very much for tuning in. Thank you, Charlie and Brian, for being our pros
to do it,
tonight.
Thank you, Mike.
We got a lot of questions, a lot of participation. Excellent. Folks, thank you for watching, for calling in. Next week, we've got Ask the Doctors. Happy Easter and good night.